Ah, the Canada Revenue Agency, our friend, right? The one that has all the rules. They must know all their own rules, right? But did you know that there are 10 common CRA rules costing you thousands of dollars every year because nobody told you about these rules? I mean, imagine this. Imagine finding out today, for example, get that brown envelope. And it's not that you owe more tax, that happens all the time, but that you've been making a financial mistake for years, one of these 10 mistakes. Not because you were trying to cheat on your taxes, not because you hid any income from the CRA, but because nobody ever explained the rules to you properly. Every year, Canadians lose thousands of dollars through avoidable tax penalties, missed opportunities, and rules they never even knew existed. Some receive unexpected reassessments in the mail or email. Some pay penalties on those reassessments, and some lose tax advantages altogether that they spent years building. Others simply make decisions that quietly cost them money year after year after year without ever realizing it. And here is the even more frustrating part. Most of these mistakes aren't made by wealthy tax experts trying to game the system, a la Mark Carney, but they are made by ordinary Canadians trying to save for retirement, maybe trying to buy a home or invest for their kids, or just simply do, I don't know, the right thing. Today, we're tapping into the CRA rules and tax surprises that can cost Canadians thousands of dollars they don't know even exist. Let's tap into the truth.
Welcome to Bakes on Things.
Welcome back to Tap the Maple here on your Sunday morning on the Bakes on Things channel. I'm Chris Baker. I hope you've had a great weekend. Let's start with the one that catches Canadians every single year. We said it earlier this week, but it bears repeating. You withdraw your money from the TFSA in July, for example. A few weeks later, you decide you're going to now put it back. You got it back. You're going to put it back in. Seems harmless, right? Not always, as we said earlier. If you're already used or have already used all of your contribution room, that withdrawal room generally doesn't become available again until January 1st of the following calendar year. Contribute too early and you may have an excess contribution. And guess what that triggers? A penalty. Generally, 1% of the excess amount for every month that it remains in that account unaddressed. That doesn't sound like much until you realize that it keeps adding up until the situation is rectified. And guess what? They're not going to rectify it for you. You need to do it. Now, that's not the only rule people don't know about. There is the business income rule we also talked about earlier this week, and I don't want to keep repeating things for you guys, but I want to cover these first two rules again, despite having used them earlier this week, because so many people don't know them. If the CRA concludes that activity inside your TFSA amounts to carrying on a securities trading business, the profits may be taxed as business income. You lose the TFSA altogether. And they don't have hard and fast rules for what that looks like. The CRA considers a range of factors such as frequency of trading, holding periods, intention, time devoted to trading, financing, and whether the activity resembles a commercial business at all. As I said earlier in that episode this week, it's so bloody convoluted, you never know if you're a business. You can have two people doing the same investment, the same profits. One is defined as a business, loses all the tax-free stuff, while the other keeps it. It's wild. But then there's also selling your cottage, for example. Many Canadians assume that because their family cottage has been in the family for decades, there won't be much tax on it. Sometimes that is actually true if done right and you talk to a tax expert, but sometimes it also isn't. If the property isn't fully covered by the principal residence exemption, years of appreciation may create a significant capital gain when it's sold or deemed disposed of, and we keep talking about deemed dispositions lately. Families are often shocked to discover the tax bill after generations of ownership, even if they aren't selling it. That is the deemed disposition, of course. They treat it like you did sell it because either the person has passed on or you've just received ownership of the cottage itself. Now, Canada doesn't have a traditional inheritance tax either, but this one is harsh. That doesn't mean that death is tax-free. We've talked about that before, but in many situations, the Income Tax Act treats a person as having disposed of most capital property immediately before death at fair market value, even if it isn't sold. That deemed disposition can trigger capital gains tax in the final return for the person, and many Canadians don't learn this until they're settling a loved one's estate. Understanding the rule early allows families to seek appropriate planning long before this ever becomes a problem, and there are life insurance solutions that can work around this as well. So again, talk to an advisor. Now, if you own American dividend-paying stocks, this is another problem. Here's something many investors never hear. We talked about this with the TFSA a little bit, but this actually goes well beyond the TFSA. The dividends in a U.S. stock are subject to U.S. withholding tax before they reach your accounts, especially the TFSA, because the TFSA generally doesn't receive the same treaty treatments as an RSP for this purpose, for example. It doesn't mean you shouldn't own U.S. investments, but let me tell you, they will ding you on that if you don't understand the rules. It simply means you should understand how different accounts types can produce different tax outcomes in both of our countries, really. Then there's the gig economy. Now, those first ones we've kind of talked about in other episodes. This one we haven't really gotten into. This is selling online, driving for a ride-share company, for example, or creating digital content like this, freelance work that you might do. Many people treat this as kind of extra cash, as a side hustle, something you do just to help yourself afford groceries in this country for once. The CRA generally treats it, though, as full-on income, and that means records matter, expenses matter, reporting matters. The growth of side hustles has created opportunities, but also responsibilities that many first-time entrepreneurs don't fully appreciate until they get a surprise brown envelope from the CRA who discovered that you run yourself a side driving business, for example. And then, well, capital gains are not just about stocks, are they? Many people hear capital gains and they think about investing. I don't need to worry about that because I don't invest like that. But capital gains can arise from a lot of things and a lot of types of property. That can include rental properties if you have them, if that's your investment vehicle, certain collectibles that you have, imagine that, investment land that you have, business assets you're a part of. Different assets can have different tax consequences, of course. And not everything people assume is tax-free actually is, so you need to talk to your tax experts or have one in general to get around some of these rules, including that one. Also, the ignorance around CRA letters. This one sounds obvious, but so many people do it. Every year, Canadians assume a letter is simply just informational, a statement of account. Sometimes it is just a statement of account. Sometimes it's asking for more documents. Sometimes it's proposing a reassessment. Ignoring deadlines can make resolving an issue much harder than responding promptly to these letters when you get them and providing these documents when you have them. Even if you disagree with the CRA's decision, responding on time protects all of your options when it comes to that. Now, we're down to our final two, but these are big two, and these are keeping records. You would think this is a very big thing that Canadians always do. Receipts, right? Trading confirmations, donation slips, medical expense documentation, business expenses. But a lot of Canadians have gotten used to the sort of trust the tax system and not actually kept any of these things. Many tax benefits depend on being able to support what you've claimed, though, in the years following in case an audit. Years later, memories do fade, paperwork disappears. Good records are one of the cheapest forms of financial insurance you can ever have. Don't just throw away those receipts because it's been 4 years, because that's when that brown envelope will be in your mailbox. And then there's assuming your tax professional has explained all the rules. This is maybe the biggest one of all, to be honest. Most Canadians assume someone has else already told them everything important. There's nothing left to learn. Their employer, their bank, their social media searches have driven some of their tax decisions. A friend, Uncle Rick. The reality is that financial decisions are often made using incomplete information in this country, and that's not because people are trying to be careless, but they're busy. They lead busy lives. They don't have time necessarily. It's because also that Canada's tax system is remarkably and ridiculously complex. There are legitimate policy reasons for many of those rules, though, but complexity comes with a cost, doesn't it? If you don't know the rules, it's going to cost you, and that cost is often paid by ordinary Canadians who only discover a rule after they've accidentally broken it and have a bill sitting on their kitchen table from the CRA. So that's the 10 most common things I think are out there right now for the CRA, but tell me yours. The lesson I hope every Canadian takes away from today's episode is that taxes aren't just about how much money you make or how much money you now owe. They're about understanding the rules before you make important financial decisions. The vast majority of Canadians want to do the right thing. It's questionable whether the CRA does the right thing as well, but that's a whole other episode. They want to save responsibly, usually, though, for their families. They want to invest wisely. They want to support their retirement. They want to support their families and some of their decisions they make. They shouldn't have to discover major tax rules by accident, and whether you think Canada's tax system is too complicated or simply needs better public education, one thing is very hard to argue with as we close this out. People make better decisions when they understand what the rules are supposed to be. That's why we do this show, to get to the truth every single time. Not to scare you into thinking you're going to get a brown envelope this week, not to create outrage at the CRA, but to share a light on information that can genuinely help Canadians protect the wealth that they've worked so damn hard to build, because the government at every corner seems to want to take it away from you. That's how you tap into the truth. Don't forget to like, subscribe, join the conversation down below. We'll be back again tomorrow morning at 6 a.m. Eastern Daylight Time for your Monday morning edition of Tap the Maple. Thanks for being with us all week this week, and we will see you tomorrow. Join that conversation now. Let's talk about it.